Why did gold, silver, and Bitcoin just crash? The Fed's secret move revealed. Three assets, three completely different worlds. One protects against inflation. One is used in factories and solar panels. One was built to replace banks entirely. And yet, on the same day, at almost the same hour, all three collapsed together. That should not happen, unless something bigger was moving underneath, something most investors never saw coming. A single decision, made quietly, by one institution, that controls the price of money itself. And by the end of this story, you will understand exactly what that decision was, and why almost nobody saw it in time. Welcome back to John A.G. Now, before going further, if there is someone watching this who has never pressed that subscribe button, this is the moment. Think of it like this. If a wise old friend, someone who has seen markets rise and fall for 50 years, sat down next to you and said, "I will keep warning you before the storm comes, every single time, for free," you would not walk away from that friend. You would stay close. You would want to hear it first, before everyone else. That is what pressing subscribe means here. It is not a favor. It is a seat at the table. So take a moment. Press it now. It costs nothing, but it means everyone watching never misses the warning again. And one more thing. Where are you watching this from? Which city? Which country? Drop it in the comments. This channel is watched by people in almost every time zone, and it always helps to see just how far this story travels. Now, let us begin. It happened quietly at first. No sirens, no breaking news alert, just numbers on a screen, moving in a direction nobody expected. Gold slipped below a price that had held for months. Silver followed within hours. And then Bitcoin, an asset that lives in a completely different world from metals dug out of the earth, broke down too. Three assets, three different stories, three different reasons investors buy them. Gold is bought by people who fear inflation. Silver is bought by factories, solar panel makers, and jewelers, as well as investors. Bitcoin is bought by people who believe governments and banks should not control money at all. They are not supposed to move together. That is the whole point of holding all three. When one falls, the others are supposed to hold steady, or even rise. That is what diversification means. That is what every financial advisor has been teaching for decades. But this time, all three fell, on the same day, within hours of each other. For anyone paying close attention, this was not just a bad trading day. This was a signal. And signals like this do not appear often. When unrelated assets fall together, it usually means something bigger is happening underneath them. Something structural. Something that touches every corner of the financial system at the same time. Think about it carefully. If gold falls because of one specific fear, and silver falls because of a completely different industrial reason, and Bitcoin falls because of a separate belief about the future of money, then three unrelated events happening at once is almost impossible, unless there is one force large enough to move all three. And there is only one institution in the world with that kind of power. An institution that does not sell gold, does not mine silver, and does not trade Bitcoin, but still controls the price of all three, indirectly, through a single lever. That lever is the cost of money itself. For over a year, a certain belief had spread across the financial world. The belief was simple. Governments were spending heavily, debts were rising, and because of that, the value of paper money would keep shrinking over time. Investors call this idea debasement. It means money loses value because too much of it is being created. And when people believe this, they rush toward things that cannot simply be printed. Gold, silver, Bitcoin, assets with limited supply. This belief did not stay quiet. It grew into one of the most powerful investment trends in recent memory. Billions of dollars flowed into these three assets, all riding the same wave, all built on the same assumption. But beliefs, no matter how strong, are built on foundations, and foundations can shift. Somewhere behind closed doors, a decision was being prepared. Not announced with fanfare, not shouted from a podium, a quiet shift in tone, a change in language, a signal sent carefully, almost deliberately, to those who knew exactly where to look. And that signal was about to end the very belief that had pushed gold, silver, and Bitcoin higher for so long. Most investors did not notice it at first. They were still celebrating the gains from the months before, still believing the rally would continue. But somewhere, In trading rooms and boardrooms, a small group of people understood exactly what was coming. And what came next would not just affect three assets. It would test every business owner, every investor, and every entrepreneur who believed the old rules of money still applied. The decision did not arrive as a shock announcement. It arrived as a change in tone. A new voice had taken the podium at the Federal Reserve, and within his very first public appearance, something felt different. The words were careful, measured, almost cautious. But underneath that caution was a message that markets could not ignore. Interest rates were no longer going to fall as quickly as everyone had assumed. In fact, they might rise. For over a year, the entire financial world had been betting on the opposite outcome: cheaper money, lower borrowing costs, a weaker dollar. That was the story everyone believed, and that belief had built fortunes in gold, silver, and Bitcoin. Now, in a single afternoon, that story cracked. Here is what most people never fully understand about interest rates. They are not just numbers on a banking chart. They are the invisible price of holding money itself. When interest rates are low, holding gold costs nothing, because gold earns no interest anyway, so there is little being sacrificed. But when interest rates rise, every ounce of gold sitting quietly in a vault suddenly represents lost income. Money sitting in a savings account or government bond now earns more than money sitting in metal. Investors began asking a simple question: why hold something that pays nothing when safer assets are now paying more? That single question, multiplied across millions of investors and trillions of dollars, was enough to turn a rally into a retreat. But there was a second force at work, one even more powerful than interest rates alone. The currency itself began to strengthen. When a nation's central bank signals discipline instead of expansion, global investors respond by trusting that currency more. Money began flowing back toward the dollar. And a stronger dollar creates a strange but consistent pattern. It makes gold, silver, and other dollar-priced assets more expensive for buyers using other currencies around the world. Demand slowed. Prices fell further. This is the quiet mechanism very few people are ever taught. It is not panic that moves markets the fastest. It is mathematics. Rising real yields and a strengthening currency together create enormous pressure, invisible to the average person, but devastating to over-leveraged positions. And there was a twist inside this twist. For months, hedge funds and large institutional investors had built enormous positions in gold, silver, and Bitcoin, all based on the debasement story. Many of these positions were leveraged, meaning investors had borrowed money to buy even more of these assets, expecting the trend to continue endlessly. When the Fed's tone shifted, those leveraged positions became dangerous almost overnight. As prices began to fall, some investors were forced to sell, not because they wanted to, but because their leverage required it. Forced selling created more selling. More selling pushed prices down faster, and faster price drops triggered even more forced selling. This is what experienced market analysts call a feedback loop. It does not require a majority of investors to panic. It only requires a small percentage of highly leveraged positions to unwind, and the rest of the market gets pulled down with them. This explains something crucial: why the fall was not gradual, why it did not creep down slowly over weeks, why it happened fast, violently, and almost all at once, across three completely different assets. It was never really about gold. It was never really about silver. It was never really about Bitcoin. It was about one institution changing its language, and an entire financial ecosystem built on old assumptions suddenly discovering those assumptions no longer held. History has seen this pattern before. Different decades, different assets, different headlines, but the same underlying mechanism, again and again. A period of cheap money creates a rally built on a single shared belief. Then, when that belief is quietly challenged by policymakers, the unwind happens faster than anyone expects. Business owners who lived through previous cycles recognize the pattern almost immediately. Entrepreneurs who had never experienced a shift like this before found themselves confused, watching their portfolios shrink without understanding why. But this was only the beginning of the story, because the real question was not why prices had fallen. The real question was why three completely different assets, with three completely different purposes, had been quietly moving as if they were one single asset all along. For decades, investors were taught a simple rule: do not put all your money in one place. spread it across different assets so that when one falls, another rises, and the damage stays contained. Gold was supposed to protect against inflation. Silver was supposed to benefit from industrial demand, even when metals as an investment fell out of favor. Bitcoin was supposed to move independently, driven by belief in decentralized money rather than traditional economics. 3 different reasons to own 3 different things. That was the theory. That was what made diversification feel safe. But when the Fed's tone shifted, something strange happened. The theory broke. Gold fell. Silver fell harder. And Bitcoin, the asset that was supposed to answer to no central bank, fell right alongside them. This is the twist almost nobody prepares for. In calm markets, assets behave according to their individual stories. Gold responds to inflation fears. Silver responds to industrial demand. Bitcoin responds to adoption and belief. Each asset dances to its own rhythm. But in moments of real macro stress, something changes beneath the surface. The individual stories stop mattering. A single force takes over, and every asset built on borrowed money, every asset held by leveraged investors, every asset tied to the same underlying belief, begins moving in the same direction at the same time. Analysts have a term for this. They call it correlation collapsing toward one. It means that during periods of extreme stress, previously unrelated assets begin behaving as if they were the exact same investment. Why does this happen? The answer lies not in the assets themselves, but in the people holding them. Many of the same investment funds that held gold also held silver and Bitcoin, often through the exact same accounts, funded by the exact same borrowed capital. When one position was forced to be sold to cover losses, funds often needed to raise cash quickly, and they raised it wherever liquidity existed. Sometimes that meant selling gold, sometimes silver, sometimes Bitcoin. It did not matter which asset. What mattered was raising cash fast. This single detail explains the mystery at the very center of this story. It was never that gold, silver, and Bitcoin shared some deep, mysterious financial connection. It was that the same investors, using the same borrowed money, driven by the same belief, were forced to sell all 3 at once when that belief broke. Here is the twist that changes how serious investors view diversification forever. Diversification only protects you when the assets you hold are bought for different reasons, by different types of investors, using different sources of capital. If everyone piles into gold, silver, and Bitcoin for the same reason, using the same leveraged strategy, then diversification becomes an illusion. It looks safe on paper, but collapses exactly when protection is needed most. This is a lesson every business owner and entrepreneur needs to sit with carefully. It is not enough to own different assets. What matters is understanding why you own them, who else owns them, and what would cause all of those buyers to sell at the exact same time. There is something else hidden inside this story, something that separates casual investors from serious ones. The investors who survived this shift without major damage were not the ones who avoided gold, silver, or Bitcoin entirely. They were the ones who understood the difference between owning an asset outright and owning an asset built on borrowed money. Those without leverage watched prices fall, felt the discomfort, but were never forced to sell. Their positions remained intact, ready to benefit whenever the cycle eventually turned. Those with leverage were forced out at the worst possible moment, locking in losses they could have avoided entirely. This single difference, leverage versus no leverage, determined who panicked and who stayed calm during the exact same event. It is a reminder that the real danger was never gold falling, silver falling, or Bitcoin falling. The real danger was the invisible debt sitting underneath these positions, debt that turned an ordinary market correction into a violent, fast-moving unwind. And this raises the most important question of all, one that every entrepreneur and business decision-maker now had to face. If the old rules of diversification no longer guaranteed safety, and if a single policy signal from one institution could move 3 unrelated assets at once, what would actually protect capital going forward? The answer was not simple, but it was about to become very clear. By now, the pattern was clear. A single policy shift had exposed the hidden weakness inside 3 of the world's most trusted assets. But understanding the past was never the real goal. The real goal was knowing what to do next. And this is where most investors made their second mistake. The first mistake was borrowing too heavily against a belief that seemed unbreakable. The second mistake, made by an entirely different group of people, was panic. Watching prices fall, many investors sold everything, convinced that gold, silver, and Bitcoin had lost their meaning forever. But history tells a very different story, one that rarely gets told during moments of fear. Every major market correction in history has followed the same emotional curve. First, disbelief, then panic, then capitulation, where even the most stubborn holders finally give up and sell. And only after that final wave of selling does real stability begin to return. The question was never whether gold, silver, and Bitcoin would matter again. The real question was where each of them stood on that emotional curve, and who would still be holding steady when stability finally returned. Here is the twist most people overlook entirely. The very institution that triggered this collapse, the Federal Reserve, does not operate with unlimited certainty either. Interest rate decisions are not fixed forever. They respond to new information, updated month after month. If inflation data cooled faster than expected, the entire tightening story could reverse just as quickly as it began. And if that happened, the same forces that pushed gold, silver, and Bitcoin downward could just as easily push them back up. Only this time, without the excess leverage that made the previous rally so fragile. This created two very different paths forward, and serious decision-makers understood they needed to prepare for both, rather than betting everything on just one. In the first path, inflation remained stubborn. The Fed continued tightening. Real yields stayed elevated. In this environment, gold, silver, and Bitcoin would likely remain under pressure, moving sideways or drifting lower, waiting for a clearer signal before any real recovery could begin. In the second path, inflation cooled meaningfully. The Fed paused or even reversed its tightening stance. In this environment, the very forces that caused the crash would fade, and capital could begin flowing back into these same assets, potentially even faster than it left. The business person who understood both paths held a massive advantage over the business person who only prepared for one. But there was something even more important buried inside this entire story, something that mattered more than short-term price movements. The long-term forces that originally pushed gold higher had not disappeared. Central banks around the world were still accumulating gold at historic levels, viewing it as protection against future uncertainty. Government debt levels remained elevated across major economies. These structural realities did not vanish simply because prices corrected in the short term. This is the difference between a cyclical correction and a structural collapse. A cyclical correction is temporary, driven by leverage, sentiment, and policy timing. A structural collapse would require the underlying reasons for owning these assets to disappear entirely, and those reasons, inflation risk, currency devaluation, geopolitical uncertainty, were still very much alive. For business owners and entrepreneurs watching this unfold, the lesson extended far beyond gold, silver, or Bitcoin. It applied to every financial decision they would ever make. Markets do not move because of the assets themselves. They move because of policy, psychology, and the invisible weight of borrowed money. Anyone who understands these three forces holds an advantage that most investors never develop. Those who reacted with panic during this collapse locked in permanent losses. Those who reacted with discipline, who separated fear from fact, positioned themselves to benefit from whatever came next, regardless of which path the economy ultimately took. The Fed's secret move had been revealed, not through a dramatic announcement, but through a quiet shift in language that rippled across every corner of the financial world. And now, the only decision left belonged to every single person watching. Would they react like the crowd, selling in fear at the worst possible moment? Or would they study the pattern, understand the mechanism, and position themselves calmly for whatever chapter came next? The market always rewards patience over panic, and those who understand that lesson today will be the ones still standing, calm and prepared, long after this storm has passed.